Welcome to Asset TV. I'm Jillian Kemmerer. We've had Brexit, the US election, we have an Italian referendum coming up, and shifting regulations in Japan. These are just a few of the major events dotting the global marketplace this year. We've heard a great deal about US valuations looking expensive compared to foreign counterparts, but practically, what does this mean and how do you source ideas abroad? Asset TV has assembled a panel of experts to share their points of view and due diligence process, so welcome to the International Masterclass. Thank you all so much for joining us here today on our rainy Tuesday in New York.
Thank you for having us.
Of course, my pleasure. So I want to get started. I alluded to a headline that I feel like we've seen across the board about U.S. valuations compared to the rest of the world. So I'm going to tee up a graphic that was on Bloomberg on November the 14th for anyone who's watching at home and watching at a later date. It's called the Fed model, and it's essentially just a look at the valuations of stocks versus bonds, and it goes off of this traditional adage that if the price, you should own equities if their price looks favorable compared to bonds. That's changing a little bit as we go into the month of December in a few days. So how do you look at domestic valuations versus international valuations right now?
It seems as if the U.S. relative to other global markets is a bit frothy. Europe, there is quite a bit of opportunity. Japan's interesting as well. One thing to focus on is PEs are interesting, but cash flows ultimately matter more. So what we do is we run concentrated portfolios, and we own usually 40-ish companies. It's a bottom-up approach, so we're looking at individual businesses as opposed to indices in general. The other thing regarding the Fed model is it looked one way at the end of 2007, but 2008 was a very different outcome. So it's not always the best sort of measure of the future. But again, all else equal, I'd say Europe and Japan feel a little bit of a better fishing pond right now.
Great. And Sean, what do you think about this growth versus value? Do you see the same reversal?
Yeah, no, I entirely agree. For me, I lean value, and it just seems to make more sense to me personally. But he's absolutely right. The last 7 years, you've seen something quite different. What I find interesting is the benchmarks and the indices and the ETFs tend to have companies in both value and growth, and the definition of where they end up it sometimes doesn't make sense to us. For me, value in large part is buying individual companies or investing in individual companies at a discount to what we believe they're worth. They may have attractive growth characteristics, but to me that's a value opportunity. But I agree with everything he just said. I think it's about time, and I do believe that active, bottom-up, fundamental, common sense approach investing that focuses on mathematics and what's achievable is probably the right approach going from here.
And Sean, kind of reorienting a bit, we often talk about Brexit and the US election in the same breath because it seems like this global rejection of status quo. Were you positioning against any of these? How were you thinking about these events moving into them?
Yeah, we were definitely paying attention to them and observing them with fascination. And I have to say, if we were making predictions and modifying the portfolio around it, we would have been wrong in both cases, but we probably would have been wrong in what we would have done, so it would have maybe canceled itself out. One thing we have learned, people are fed up, more people do show up at the polls than are expected, and the pollsters, at the voting booths than expected, and the polls are wrong generally. So we pay attention to these factors, but we don't necessarily position around them. As my colleague here mentioned, Brexit's going to take a long time to sort out, and we don't know how it's going to look. The new president, how that's going to look is unpredictable, and what we focus on is understanding and trying to understand things that are predictable, stable, and investing in great businesses. A lot of these macro factors will weigh in, but we don't have the clarity, we don't have the vision to know what it's going to look like 3, 5, 10 years down the road, which is the investment time frame we look at. So we listen, we learn, we're patient, and we just focus on buying great companies.
So there's another area of the world that's been very popular in conversation lately. It's Japan. Just yesterday, Morgan Stanley joined Nomura in saying that they believe the country's bull run is going to continue into 2017. They recommended selling U.S. shares to fund a trade. Very dramatic turnaround given everyone's sentiment on Abenomics a little bit earlier this year. So Sean, what are you thinking about Japan?
Yeah, I just would add to what these two guys have said here. It's been a fascinating period of time, particularly these last 3-4 years. The discussions have completely changed. Return on invested capital is something that most CEOs actually talk about now. It was a foreign concept 3-4 years ago. Balance sheets are changing, attitudes to leverage are changing, share buybacks, which you never saw, are happening. Cross holdings, which was mentioned. Also, boards are becoming smaller. They're adding women to boards, they're adding minorities to boards. The complexion and the whole sort of governance aspect of Japan has changed. I think it's a good thing for Japan. We've also increased our weight in Japan over the last 2 to 3 years, finding more opportunities, finding more companies that actually speak sort of the language of investing that we speak and are focusing on what we believe are the right attributes, in large part as it pertains to capital allocation and things like being more efficient and laying people off, which has been taboo for years. There's been an employment for life mentality that you sort of started company X at 18 and at 65 you retire. That attitude is shifting, and I think it's great for the country, and I think it's improved the fishing pond for folks like us to invest in Japan.
So I want to actually transition from our macro discussion and begin to talk a little bit about each of your individual investment processes. Many of you, if not all of you, employing a bottom-up approach. So I want to talk a little bit about what your underlying investment philosophy is and what your due diligence process looks like. I feel like for an international focused portfolio, that's always very interesting, particularly because you're each based somewhere, but you're trading everywhere. So Sean, what's your due diligence process like?
Yeah, well, we have an approach where we focus on quality first, so that narrows the universe down quite a bit, and we define quality a variety of ways, but these are companies with high returns on invested capital that exceed their cost of capital. They're companies that have some sort of moat or competitive advantage, but they're different and or special in their own way. They're typically market share leaders and gaining market share. We also focus a lot on valuation and make sure that using normal, realistic, long-term assumptions that the intrinsic value that we come up with is meaningfully above where it's currently trading. We also identify catalysts that we believe that's going to change the gap, because we believe the market in the short run is pretty inefficient and can be pretty inefficient and give us a good opportunity. From a portfolio construction point of view, we run a concentrated portfolio, so we're always between 30 and 40 holdings. We're at 36 currently, and really employ a long-term view. We assume we're going to hold a given investment for 3 to 5 years, but at present, about 25% of the portfolio has been held more than 8 years. So we're not, we like to say we use a private equity approach to public investing, but we're not like a private equity fund in that we have to exit at year 5. We don't have vintages on our investments. We're happy to keep investing as long as the margin of safety that Fabienne mentioned is still there. There's sufficient upside and there's sufficient catalysts. So very low turnover as a result of that, sub 25% since inception. And we're just patient and methodical and look for great companies to buy at the right price.
So 3 to 5 years is how you classify your long-term horizon.
That's the starting point, yes. But at the end of 5 years, we're not forced to sell. We always say we invest in businesses. We don't trade stocks.
Right.
We don't have much to talk about in a quarter. That's okay.
No.
We don't want to fill airspace with words. We want to generate long-term returns. Period.
Just pushing on it a little bit, I think absolutely as portfolio managers you are prone to patience, at least on this panel, but how do you convey that to your investors, many of whom are prone to making very emotional decisions?
I think it's just you explain it and you demonstrate by activity. You look back and say, back in 2008 we bought this company, look how well it's done, and we continue to hold it. And we obviously admit to our mistakes too, but I think as much as the past doesn't predict the future, I think it's one of the best indicators of the future, and your behavior over the last, in our case, we've been doing the strategy for 9 years. What we've done for the last 9 years isn't going to change for the next 90. And if you can buy into it for the last 9, then you should be okay. But know that we're not going to outperform in every single market environment. But if you look at us on trailing 5-year returns, I feel pretty good about how we do things.
I have another question for all of you along these lines. Currency hedging, interesting question. Are you or are you not actively hedging? And if not, why not?
Yeah, we looked at hedging when we launched the strategy about 9 years ago, and we have the ability to hedge, but we haven't to date, and I don't see us actually doing it. Couple reasons. One is our larger institutional clients like to hedge themselves, and they have a currency overlay, so they specifically ask us not to. Additionally, the management teams that run these 36 companies that we own do a lot of their own hedging, and they have much more visibility on their exposures and what they need to take care of. So anything we do could offset what they've already done. And just to echo what I think everyone here said pretty much is, it's not it's not one of our strong skill sets. It's not our expertise. When I moved to the States in 1975, the pound was at 240. 10 years later, it was at 111. Fast forward to the year we launched the strategy, it was about $2 to the pound, and now it's, I think, 125. I don't think anyone could have predicted that, and I know we couldn't have. So we try to stick to what we know, analyzing companies, analyzing management teams, running a concentrated portfolio, and we're not hedging, to be short.
Okay. So we're actually coming toward the end of our discussion, which I can hardly believe. I feel like we could talk about this all day. So I just want to give you each an opportunity to wrap up. Anyone that's watching this at home, or advisors that like to watch, or institutional investors, what's something they should take away from this, either about the international markets generally or about your firm's approach to them?
I would say that having an international component to your equity portfolio is a critical part of any long-term investment approach. both in developed and emerging markets. And I think it not only gives you additional exposure to some exceptional companies, but it broadens the fishing pond, if you will. And I know I've said that several times, but it gives you a better universe from which to select global leaders. The world is increasingly more global, even when you buy what might be defined as a U.S. company. In many cases, you're getting non-U.S. exposure. I'd also argue that, individual stock picking and active management does make sense, and a focus on cash flow is critical. Ultimately, the only thing that determines value is the free cash flow of a company and the capital you have to put to work to generate that free cash flow. Everything else is just noise. So the market is short-sighted, and select managers that can see through that and be patient and invest intelligently.
Perfect. Well, thank you all so much for taking the time to share your expertise with us. It was an interesting year this year in the global markets, and I expect that 2017 will be equally interesting, so we look forward to having you back.
Thank you.
Thank you very much. Thanks, Will.
And thank you so much for tuning in. From our studios in New York, I'm Jillian Kemmerer. Thank you for watching this episode of Masterclass.